Good. Good to see you. How are you?
Good, good, good. Sorry, I'm fumbling my way through technology here today.
No,
So,
you're perfect.
all
You're
right.
perfect. We just finished the countdown timer. So we're gonna
Okay.
say hello to some folks. So you guys can be very active in the chat. That would make it really wonderful for us. So we have a presentation planned for you. It'll probably take about half the time, and then the other half the time we want to do Q&A. So what do you guys want to know about? Use the Q&A feature, use the chat feature during while we're talking, and we'll kind of glance over and I'll skip your questions if I know we're going to get to them later in the slides. Otherwise, I'll take them. And when you're chatting, feel free to use the drop-down menu that says everyone. That way you can all see what everyone else is interested in. And Audience, has anyone seen Ben before? Does anyone know who Ben is? If so, say hi, Ben. If you know Ben, I'd love to see. Because we have not had Ben on our stage before. So, okay. So this is great. It looks like you're a
Hi,
new
everybody.
It looks like you're a new face to everyone. So this is perfect. All right, you guys. So what are we going to talk about today? We are recording this. We'll send out the replay later today to everyone who registered. Feel free to share the replay with anyone. It's not private information. There's nothing proprietary that we're sharing here. Share it with those people that you discuss your investments with. If you have an investment committee, a bunch of friends or family members where you bounce ideas, around with each other, feel free to share this with them. It's going to be very data driven. So it's a really good tool to take notes on what we're going to talk about today, to take notes on what we look at before investing in a market and how you can do the same. So today's agenda, I'll introduce Ben. I'll let him introduce himself a bit as well. We're going to specifically talk about San Antonio market statistics, why San Antonio is a good market to be in right now. Ben already has property there. He's exited properties there and had some really amazing results for his investors. So he has a lot of experience in San Antonio that he can share with us. We're going to show you where we get the market data. So in the presentation, it'll often say where the data is from, and then I have a link to share that you can sign up for newsletters to get market data. And then we're going to share with you on a particular property that Ben has under contract in San Antonio, like the data that we look at, how does that plug into the underwriting and how does that affect the investor return? So that'll be right at the end. So with that, I'll start by saying, Ben, thanks for being here. This is a
Thank you,
long time
Sarah.
coming. So
Yeah, no, excited
everybody,
about it.
yeah, thanks for being here. Everyone in the Sugo community, Ben and I met, maybe it was 4 years ago, the first time, Ben. Um,
Yeah, no, well, no, I think it was actually pre-COVID, and then I think
okay,
it just, yeah,
maybe.
kind of it got kind of jammed up with what happened with COVID, and we lost touch. And then we have obviously a lot of similar acquaintances that we all know. And so it was good to finally reconnect. Let's just put it that way.
Yeah, definitely. And we reconnected several months ago, and Theo went through the due diligence process on Ben and Disrupt Equity. And so we're looking to add Ben as a sponsor that the Sugo Build Your Own Portfolio funds. So the different projects that they have coming up will be offered in the Sugo Build Your Own Portfolio platform. So you can see it there soon. We'll be sending information about that soon. But this is just the beginning of is the educational webinar. We're not going to present any of the specific opportunities. It's more so that you can get to know Ben and how he and his team and his company use data to make decisions on when to enter a market and make their purchases, because the purchase is where we all make money. So Ben, with that, why don't you just take a couple minutes to introduce yourself, your background, and how you got into this space.
See, take myself off of mute
Yeah.
there. So,
Mhm.
no, again, thank you, Sarah, for having me on. And I'd love to just, kind of get on and talk shop about multifamily and why we love it. And, I mean, ultimately, why we think it's a great investment opportunity for the next 20 years, right? But, to kind of take a step back, got into real estate and like a lot of people do, kind of got on the single family side, right? So it was back in I think 2011. I started doing fix and flips. Did about 60 or 70 of those over the next couple of years. Had some rentals, but ultimately just got burned out, right? And this is the
Yeah, that
same you
sounds
probably
exhausting.
it was exhausting, right? And at the time I had a full-time job, so I was pushing 80, 90, 100 hours, a week just trying to kind of manage all of this. And so, I had the bug. I had read the book from Robert Kiyosaki, Rich Dad Poor Dad, and it really just, it kind of had a light bulb moment for me. And so I think I wanted to stay in real estate, but I didn't want to do fix and flips anymore. So I
Yep.
started kind of doing a lot of research about what I wanted to do, and I found multifamily. So got into that probably 2013, 14, bought my first property in 2015, and was doing that kind of on my own and through another partnership for a couple few years, but I understand the power of networking and social media and doing all of these things. So I had networking groups in Houston that I was hosting. And one of the gentlemen that kept coming out month over month, I must have been doing something right, was a guy named Ferris Musa, who's now my business partner at Disrupt Equity.
Mhm.
And so we became friends first. I think it's important for people to realize with partnerships, that it's very much like a marriage, right? You have to like, know, and trust that person first, but you also just you need to have similar, ambitions and goals. So you're all kind of marching in the same direction, but you also need to have complementary skill sets. And I think Ferris comes from kind of a more IT role. I'm more of a sales and marketer. And I think it was very complementary in terms of that. So we did a deal kind of just on our own together just to kind of test the water. That went well, and that's one of the track records that we've had in our career. And then we ultimately decided, hey, let's make it formal. And we created Disrupt Equity in 2017. So we're based in Houston, Texas. Me and Ferris are business partners on Disrupt Equity. And, we started buying properties in Texas as well as Atlanta because we really like there's a lot of similarities between Atlanta as well as Texas. And so, we did very, very well there in the last, probably 7 years, 8 years that we've been buying there. And we created our own management company right before COVID happened. So January of 2020 is when we created Emerge Living. Some people say that it was like very bad timing. I'd say it was actually very good timing
Okay.
because at the end of the day, we were able to take back our portfolio from a third party property management company, and that allowed us
Mm.
to, have control and transparency and flexibility during those very tumultuous times, right? If everybody if you were in multifamily, you had to pivot almost daily. There was new
Daily.
rules and regulations. Like we'd come in and the property would be sick with COVID. Oh my gosh, what are we going to do? How are we going to handle maintenance orders when you can't get into people's, units? So it allowed us to be nimble in a time that we needed to be nimble.
That's
And so
great.
we cut our teeth that first year.
Mm.
We've been building upon that foundation ever since. And so, we're a vertically integrated shop. And then, in 2023, we created Stealth Renovations, which is our construction company. And so we kind of identified areas where we could be more of a value add to the partnerships and to these investment opportunities that we have with our investors by bringing some of these things and vertically integrating them into the bigger stack. And so, over
Mm.
the course of, the last 10 years that I've been in the business, I've bought and sold about 8,000 units. We currently have about 6,000. And then our management company, we also do first and third party management. So,
Mm.
we manage our 6,000 unit portfolio, but we also manage another 2,500 units for other people. And that's a part of our business that we're going to continue to grow because there's a lot of economies of scale of having a bigger portfolio. And so we're really, really proud of each of those individual companies. And we're continuing to look in these same markets, right? Texas, we're right here in Houston. San Antonio, which we'll get to here, is right in our backyard. It's 2 hours away from here. We love the Texas story, so we can kind of get into that. But we also like Georgia and Florida as well. So over the next few years, we feel like there's going to be a lot of buying opportunities. So we're just looking for great partnerships and but at the end of the day, I love educating people because I think an educated investor, an educated partner is a great person to have on the team, right? Because they're
Yes.
going to understand the ebbs and flows of an investment opportunity, and understand the risks of these and
Hmm.
how they're being de-risked. And I think that is
Hmm.
important for people to understand, right?
Right.
Because it's not all like a straight shot. There's
Never
ups
is.
and downs along the way, right? And so
Hmm.
you want to make sure that you like, know, and trust the person that you're putting your money with, but
Hmm.
understanding that when those things happen, because they're going to happen, anybody that says that they're not is not telling the full
100% they'll
story.
happen. Yep.
There's always going to be something that's going to happen, and you need to have not only the grit to see it through, but the team and the partners to come together and actually get it through to the finish line. And I think that that's important for people to understand.
Yeah.
And so, really, really excited to be with you today. Happy to answer any questions about anything multifamily related. And just happy to be here.
Perfect. Well, sounds good. Thank you for the intro. And I'm going to, oh gosh, of course, now I started sharing. There we go, slideshow. So I'll start sharing. And this is an excerpt from a larger deck that you guys have been that I thought was really great because it goes really deep into San Antonio.
Yep.
And it really shows how you guys analyze a market. And so there's a couple slides just in the beginning, you guys, giving an overview of disrupt equity, and then we'll get into San Antonio. So general disclaimer, this is not an offering. Do your own research. That's basically what there's that is saying. This is what Ben was just saying, how many units they've acquired and the locations that they have acquired them in. And
Mhm.
so today we're going to talk about San Antonio. They have properties there, they've exited properties there. And then at a later date, we're going to talk about Atlanta. That's also a market that they're quite bullish in.
Mhm.
So you'll see that in the future, and that'll be fun as well. Um, I think this is really impressive. So, Ben, I'd love it if you just took a moment to share some highlights. These are the exits of Disrupt Equity. And if you guys look below the picture, the last line, it says investor net annual return. That's the yearly return, not the overall return from the projects. And so you can see that's really strong. The lowest one was 20%. And the rest are really exceptional. And so when I was looking at the track record of Disrupt Equity, both currently what they hold and their exits, I thought this was really telling of how successful the team is at analyzing markets, and choosing properties with their underwriting, which is what we're going to talk about today. So anything you want to share about this, Ben?
Yeah, I was just going to say that this is just a snippet of it. There's a few more that we have exited, and then there's a couple that we've done cash out refinances for.
Mhm.
One that I wanted to point out was Alamo Oaks, right? Not only did I do a cash out refinance of I think it was roughly about $2 million, we also then turned around and 2 years later we sold it for that return too, right? So some of these have had multiple kind of exit wins.
Interesting.
And I think a lot of it boils down to buying them, right. Basis matters,
Hmm.
right? Structure matters, right? How do you structure your deal from the debt to the equity to everything in between? And then
Hmm.
again, it goes back to team and execution, right? So, really, really proud of this. Ultimately, I think people are going to start seeing this as the market starts shifting back into, a very strong kind of tailwind. You're going to
Hmm.
start seeing these returns, again. And I think that's what's exciting about, kind of getting in multifamily and starting really investing right now.
Hmm. So let me go back a slide. So for San Antonio specifically, how many units do you currently have there? How many? I know you have about
So we currently own about 600 units. We manage another 600. So between ownership and management, about 1,200 units in San
1,200.
Antonio.
Okay. So I
Hmm.
bring that up to you guys to say yes, they're doing their research with third-party data, and they have a presence there of 1,200 units. So they're in there day in and day out, experiencing the market and what it can bear as far as occupancy and rent and all that.
Yep.
Oh yeah, we talked about this, just a slide about your property management company. All right, so we're going to get into some data, but just to start, Ben, on from a qualitative side of things, why do you love San Antonio? Why are you buying in San Antonio?
So I think, at the end of the day, San Antonio's kind of the sleeper, right? Everybody knows about Austin, right? But I always tell people that San Antonio is only an hour away from Austin. And it's right along this 35 corridor, right? So you have San Antonio down here, you have Austin right here. Well, in between there, when I used to live in Austin 25 years ago, there was nothing there. Now, if you go through there, it's one contiguous development. And
Mm,
so I'm of the opinion that over the next 10 years, it's going to be the next metroplex in the United States. And so there is a fair amount of population growth and people moving to just Central Texas in general, right? But one of the reasons that I love San Antonio over, say, in Austin, and I still love it, Austin, But right now, San Antonio is the more cost effective place to live and operate a business in comparison to an Austin. Yet you still get all the Central Texas, hill country, rivers, lakes, all the fun stuff that you do in Central Texas living in San Antonio. And then you get to do it for, 50% of, what you'd have to pay in Austin. So I think that's one of the reasons why. And I think at the end of the day, what a lot of people don't realize is it's top 10 in terms of population in the United States. It's bigger than the city of Dallas. And so people are like, wow, I didn't realize that. In fact, there's people that I was talking to about in the office 6 months ago. I was like, yes, like I forgot the statistics, either number 9 or number 6, right? And so at the end of the day, like there's a tremendous amount of population growth, but there's also just a lot of population already. And so I
Mhm.
think that that also just drives job growth and businesses wanting to move there because there's a good, feeder of potential people that they can hire on. And I think, again, you talk about cost of living and cost of operating a business. It's going to be a lot more cost effective to do that in San Antonio. So those are some of the like macro big reasons why I love
Yeah.
San Antonio. And then the fact that it's 2.5 hours away from me. So even if I need to get out there tomorrow, I can just drive. It's not logistically, it's right around the corner from me, right down I-10. I love that too.
I think that's really important for operators and sponsors to have easy access to their properties for sure.
Yeah.
Okay. Now I'm trying to proceed to the next one. Why isn't it going? Okay. Do you see the next slide now, Ben?
I do. I see it. All right.
Right. So when looking at this is kind of a getting into more of the specifics about, what you just said generally, but demographics are really important. So you want population, you want growth, but you also want the right kind of demographics for what you're trying to do, the type of properties, the type of real estate you're looking to own. So let's just talk about, okay, so this is specific. Sorry, let me just skip this one. What's this one? There we go. So that last one was specific to the property. Sorry, guys. So here's some really specific information about a submarket where they're purchasing a property. So if you want to just run through this and say, why these things are important for you guys.
So, I mean, obviously each city's made up of, I like to always kind of quarter it out, right? And I think when you're in San Antonio, the north and the northwest part of that city is really, really going to be one of the better ones to kind of focus on. And I'm going to tell you guys why, right? And it's not even about the fact that it's got Joint Base San Antonio, which Lackland Air Force Base is the biggest Air Force base in the country. That's a little bit further south. And it's not necessarily something that's applicable to this property or that area, but it's just a big driver of the economy, right? So I want to always mention that. But the real reason why I like that kind of northwest sector is a couple different things, right? It has a huge medical center. And so, I mean, one of the biggest in the country is located smack dab within a couple miles of the property. USAA, so people, probably heard it. It's a big bank insurance company that is affiliated with the armed forces, is headquartered in San Antonio. It's one of the biggest employers, if not the biggest employer in San Antonio. UTSA, which is a big kind of satellite college that is affiliated with the University of Texas. It's University of Texas San Antonio is literally right around the corner from the property as well. So you have all of these, and then you have Six Flags Texas, you have the Rim, La Cantera. These are kind of these more affluent, kind of mixed use developments that are all within 5 or 10 minutes of the property. What does all of that mean, right? All that means jobs, right? And so yes, not the doctor that's working at the medical center, no, he's not going to necessarily be working at our property, but he's going to go to the Starbucks. And the person that's working at the Starbucks might be living at our property. So these people feed the overall economy. And then there's blue and gray collar folks that also are going to service those people that are in the white collar communities. And so I think it's important to always be adjacent or in the midst of where the job growth is happening because that just drives the overall, I guess, consumption of rental units in your submarket. So it's always important to have those pockets that are close, right? Because not everybody's going to want to travel in 45 minutes from outside and and work somewhere else, right? Most people live within 5 to 15 minutes of where they work. And that is just a statistic that is just a ironclad. And so you always want to be close to those job centers, right? And I think the other thing too to point out is just again that population job growth as a whole, not even necessarily specific to the Northwest submarket, but just as a whole, it's very, very strong, right? And that's backed by a lot of new development, right? They're expanding highways, they're putting in new industrial, they're putting in, new things that are going to kind of drive or help, augment this growth that you're seeing in this area, and that's to the tune of billions of dollars. And so you always like to see that new development. So even within the pocket of where this is, there's a lot of new development happening there. So that's where the best part, in my opinion, been investing there for 7 years, is in San Antonio. But I think is if you look at any market, doesn't matter if it's San Antonio or something else, you always want to look for those things, right? Where's the new development? Where are the job centers at? And then you could even ask a residential broker, what's the hottest part of town? And they'll tell you, for the most part, like, oh, you need to be in La Cantera, you need to be at the Rim, right? You need to be adjacent to that because that's where all the restaurants are, that's where all the shopping is, that's where all the retail is, that's where the grocery stores are at. Like, and most people again want to live close to where they're going to be on the weekends. And
Yeah.
so that's what I love about this part of town is it has all of those things. And so, and there's other parts, there's little other pockets of San Antonio, but if you're looking at San Antonio, you want to look at the north, and you want to look at the northwest. That's typically what you're looking at.
Love it. And if you guys see on the bottom right, number 10 best city in America to live in, number 6 best city in the US, number 2 best place to live in Texas. So it has the jobs that are driving the growth, the population growth. You can see the job growth on the screen here and the residential growth on the screen here. And so you need the jobs, but it also needs to be a great place to live. Just like Ben was saying, if there's great shops, restaurant, retail, ease of living. And so that paired together makes a really strong market with a lot of demand, especially if you have apartment complexes.
And one thing I wanted to mention, I mean, I know you're in the Bay Area, you probably have some California people, some people that are kind of affiliated with the tech sector, right? And so the one thing that I think is an interesting I guess trend that's happening is that a lot of tech companies kind of moved to Austin. Well, for various reasons, obviously that's still happening to an extent. A lot of them are now starting to look at San Antonio. And again, it goes back to my earlier statement, which is it's easier and cheaper to live in San Antonio and operate a business there, but yet you still get the benefits of why everybody loved Austin. Everybody loved Austin because it's Central Texas, it's hill country, it's
Mhm.
wine country. It's got rivers. It's got lakes. And I'll admit it. I'm a Houston guy. The most beautiful part of Texas. But now you can do it, and you got the low business costs right here, right here. You've got the advanced telecom infrastructure, but you also have big colleges that you can use as feeders for potential employees for those businesses too. So a lot of people are talking about like, hey, setting up tech, startups or tech firms moving to San Antonio. And I think that that's an interesting trend that 10 years ago nobody was doing that in San Antonio. It was all Austin. And
Yeah.
so I thought that was an interesting trend just to kind of point out.
Yeah, I think it is. And it was when I first started getting into multifamily, I think we went to visit, it was 2017 or 2018. We went and we toured the corridor and the amount of construction around Austin. I was like, oh my gosh, this is going to be so expensive so quickly. And we didn't pull the trigger in Austin. And in hindsight, it was probably a good move, but it was like, a great place to have bought property in a year or two before we got there and we started looking. But yeah, you can kind of see San Antonio as the next Austin for sure. And how I'm trying to remember because it's been a while since I've been there, but the drive from Austin to San Antonio, how it's less
45
than,
minutes to an hour, just depending on traffic.
yeah.
Again, and it's there's just so much infrastructure. It's I-35. I-35 goes all the way up to I think Minneapolis, and so it's a major artery throughout the middle of the United States,
Mhm.
and that connects San Antonio to Austin and that whole entire area. Again, give it another 10 years, it'll be the next metroplex.
Yeah, definitely. And so many people from California went to Austin at the beginning of COVID and never came back. And then a lot of people in Austin are like, oh, damn you, Californians, you drove up the price of everything. Californians are
Well,
like, I don't
you
care.
have it. The
I'll
one thing
overpay.
that we love Austin, but it's like a Miami, it's like a Nashville. There's a lot of it went up quick and then it goes back to like whereas San Antonio, Houston, DFW have been kind of just steadily growing. And I think
Yes.
that's the more healthy way to grow.
Mhm.
But I mean we still love our Austin. There's still a lot it's a cool town.
Yeah.
Don't want to hate on it too much because we own property there too. But I think San Antonio's got a lot to offer, and again, this slide kind of tells it it's a lot cheaper to do that than it is in Austin.
And from what I've seen, the return projections are much higher in San Antonio than Austin. So that's a bonus for investors as well.
Yeah.
All right. I don't want to repeat anything, but is there any new information on this slide?
I mean, I think I think it's kind of reiterating kind of the growth of
Yeah.
jobs and population growth, and I think that this just kind of reaffirms kind of what I've been saying, and
Hmm.
it's good. That's going to be a trend. That's not a again, that's not something. And even Austin is continuing to grow, and so we see over the next 10 or 20 years, the Texas story is just it's just now getting started. There's more and more people moving to this area, and I think again that's going to increase the need for rental units. So I think
Hmm.
you're just playing into those tailwinds.
So if you look at if you guys are looking at a market and you want to do your own market research and you're wondering where do you find this information, like okay, San Antonio's GDP grew by 4.6%. It's really easy to Google it. Years ago, the information was not as accessible, but this is not information that Disrupt Equity or Sugo Capital created. The research is out there. There's tons of free third party groups who do this research. So you literally just have to Google it. And so when you're looking at a market to purchase real estate in, you're going to want to look at GDP. You're going to want to look at the number of jobs. So that's the next one. You can see it's almost 22 or 21 thousand jobs, 1.8 growth rate of jobs. So taking a look at those numbers, Googling those numbers, and then I think it's really important to compare them because you don't know is that good or not good? I don't know. But if you compare it to what's going on in the United States, or if you compare it to what's going on in Texas, then you'll know relatively is this market expanding or is this market contracting based on what's going on around it. So everything's relative. You're going to want to have these statistics because you're going to compare it to the state and the country numbers to see if it's expanding or contracting. And then when you look at the property that you're going to purchase in that MSA or in that city, you're going to compare the property metrics to what's going on in the market as far as vacancy and rent. So that's all very important to do your research around. Now, I think the next slide is more specific on submarket demographics. Here we go. So this is interesting. This, I think, is a little bit, or why don't I ask you, Ben, where did you guys find this data that's on the screen?
So again, a lot of stuff is free these days. I think I saw something in the chat there. I mean, CBRE is a big. I mean, we subscribe to a lot of databases, so there's a lot of information that we pay for as well. But a lot of this you'll get from a broker deck, right? So the broker that's selling the property might have some of this information, but then we're always validating with city-data.com and some other various websites that will have not only population growth, but they'll have median income, they'll have household values, they'll have a lot of these statistics where we then further validate it and just make sure that we're not just getting our data from one source or not, because there's variations, right? But I think the one thing
Mhm.
that I like to point out to people is average household income or median income is an important statistic. And I'm going to tell you guys why, right? Because at the end of the day, you want to make sure that your property and your business plan is conducive with the people that live in that area, right? Let me give you an example, right? If you're going to build a property and you want to charge $3,000 rents, but everybody in the area only makes $50,000 a year, and these are extreme examples, I get it, you're never going to have anybody rent there
No.
because at the end of the day, you've priced everybody in that area out.
Mhm.
And so what we do, how we kind of back into it is we take what our average rent will be after we kind of go through our business plan, and then we 3x it, right? Because that's the credit criteria that we expect from our residents, right? And then you annualize that. How much buffer do you have in between that, right? And if you're kind of topping out what the average income might be, or you're above it, you might have a problem being able to lease or keep residents there because in that area they might not be able to afford that. And I think that that's an important statistic. People kind of downplay, well, why does it matter if they only make this amount of money? It's very important
Very
because you want to make
important.
sure that they can actually afford the rent that you're trying to charge at your property.
And
And
that they can
so
afford it comfortably.
and they can afford it comfortably. It's not like, and we talk about affordability in this country, and it's a true challenge. And so you want to make sure that you are pricing your units effectively, and can attract and continue to attract new residents that can afford that comfortably.
Hmm. Perfect. On the next slide, talking about rent versus own. And so,
Yep.
why is it important to look at this information?
I love this slide. This is something that we've only recently, well, we started doing it about 3 or 4 years ago. I think the reason that it's interesting is that you want a good, healthy, buffer in between the two, right? And the reason why is that so say for example that on this new property that we're talking about, I'm going to try to charge $2,500, right? Well, why wouldn't somebody at least entertain the idea of going and buying a house, right? Because in this case, there are only $2,100 rent, or excuse me, mortgage payments. So it's important to have a good buffer between those two, because at the end of the day, right, you don't want to price your residents into like saying, you know what, Ben's charging too much. I'm just going to go get a house, right? So you want to be comfortably in that market, and so you don't want to be competing against single family homes, is I guess the point that I'm trying to make. And so I think it's important to have a healthy kind of buffer between the two. And so this kind of
Hmm.
shows that there's about $1,000 difference between what the average mortgage is in this area versus what the in-place rents are, right? And
Hmm.
even if I say I want to go through my programmatic unit renovation program and I'm going to increase rents by $200, right? You still have a $700 or $800 delta between the two.
Hmm.
And so it's just another data point that you want to have when you're looking at different properties, and is my business plan achievable, and does it make sense, right?
Right. In in California, of course, it's completely different, completely upside down. Everything related to housing, it doesn't make sense. But when we moved out of the country during COVID and we were renting our house out, renting it at about 50% of what the mortgage was. And we were like, this is ridiculous. It's so crazy. So when we came back, we were like, why are we doing this? So we sold our house and invested the money, and then the income from our investments more than covers our rent. And so it's interesting to see in markets like the San Francisco Bay Area how things are shifting. Now housing prices are coming down. Things are much harder to sell, whereas 5, 6 years ago, you could barely, I mean, something would be on the market for like 24 hours and it would be sold, 15% above asking. And
Yeah.
now stuff is staying on the market for 60 days and people are starting to realize, oh, it's you know, we
It's more of
just,
a buyer's market, right?
mhm,
You're starting to kind of shift, right? It went from a seller's to a buyer's. But I
mhm.
think the one thing that's interesting, especially for folks that might be on the West Coast or maybe in Hawaii, is look at those house prices. Like that's Texas, right? You're probably like, man, that's you could buy a house and you're only paying 2,165 bucks a month. And that's kind of where things are at. And so I think it's an interesting kind of, difference between the two markets.
Yeah.
But, again, the meta point for this slide is always about like making sure that there's a difference between the mortgage that you would be paying
Hmm.
versus the rent that you'd be paying.
Hmm. And the next slide, we kind of covered parts of this already, but it's talking about how close are you to jobs and a variety of jobs and the quality of
Yep.
jobs that you're close to. So, there are places where there might be a ton of jobs, but they're all in one industry and they're all kind of one level. And so a really healthy job market is one that has a mix of industries, a mix of jobs, and a mix of for lack of a better word, like levels of jobs,
Yeah.
range in pay.
Yeah,
Um,
and so yeah, you've got obviously a dichotomy here of various things. I mean, and there's obviously energy, and there's a lot of manufacturing, and then, like I said, there's tech, and
mhm,
everything is again. I mean, you kind of show the differences where Lackland or Joint Base San Antonio is to kind of the southeast part of town,
mhm,
whereas where you see where 410 is, if you go north, that's kind of considered North San Antonio, and this is where all the major job centers are. And I didn't mention Valero, but Valero is a Fortune 500 company, and it's in this pocket. So
mhm,
this is just where all of the major employment centers are.
Hmm.
that you're trying to kind of be around in San Antonio.
Well, and another thing to look at, besides employment, is nearby construction and development. And we hit on this as far as the corridor between Austin and San Antonio. But specifically in these areas, where do you want to see construction and development? Is it basically an indicator that, yeah, why don't I let you take that
I
one?
think you know, as a multifamily guy, you're like, oh, I don't want to have multifamily development, but I actually feel like it's validating in some ways. Yes, you might have some short-term pain because you're kind of competing for the same resident or renter pool for a little while. But ultimately, I'm a proponent
Mm-hmm.
of any new development is good development, right? Because those people are further validating that growth is happening in that area, that jobs and population growth is happening in that area. And I think that that's an important part of an investment opportunity, right? Is you want to be adjacent or in the path of those things. And so
Mm-hmm.
seeing those things and seeing even, like I said, the expansion of 1604, which is just a big highway system in San Antonio, that means not only is the private sector putting in money in, but the public sector is also seeing the growth and expanding
Mm-hmm.
highways and making things more accessible to that growth that they're seeing. And I think it's important to see both. It's kind of painful, at least in the interim, because you got construction, it's kind of dirty and all those things. But I say for a long term perspective, because you get
Mm-hmm.
residents in, you're like, hey, you're adjacent to this, or you're only 2 miles away from that, and oh, by the way, there's this HEB or this Kroger or this Whole Foods. All of these things are very very close to you. Residents love that, right? And
Mm-hmm.
so that's part of your sales pitch when you're a leasing agent.
Mm-hmm.
So I love to see these things, and so these are just some of them that are happening in the area. And then for a lot of people, they probably know San Antonio as like the Alamo, right? And so and the Riverwalk and all the things, and that's an important part. So San Antonio, we don't really play into it too much in this presentation, but there's just a lot of tourism that goes on there too. In fact, as a tourist destination in Texas, it is the biggest tourist destination. People come to see the Alamo, they go to San Antonio. It's got a lot of history. And so there's a lot that's happening in downtown San Antonio, which is only about 15 minutes away. And so
Oh,
you see
wonderful.
this too, right? La Cantera is another big mixed use development, and there's a lot happening here.
Yeah, it's awesome. Lots going on.
This
So
is, this is what I was talking, the 1604 expansion.
yeah, yeah. So we kind of already hit on this. Um, and then this one is just kind of showing um, all the different jobs, all the different amenities. Right in the middle of everything is where you're purchasing, Benton. Anything else do you want to say about this? Kind
No,
of,
again, I mean, you're always wanting to be adjacent or close to this stuff. It just
yeah,
makes your life a lot easier when you're trying to lease things up because, again, you can
right.
point to the fact that these things are right up the road.
Yeah. All right. So you guys, next what we're going to do is we looked at a bunch of data and it's like, okay, yeah, but how does that affect a property? So we're going to here, I'm gonna stop sharing for a second. Um, so Kath, if you would put a link in the chat, and that'll be to I'll start sharing again. I just needed to pop over to a different there we go, different application. So if you guys want to grab some market data around rents in different markets and what's going on, and you're like, I just kind of want push notifications. I sign up for this ALN apartment data. You put in the markets that you're interested in, that you either currently have properties in, because you're going to want to watch the statistics to know when to get out of that market. And then also it helps you know when to get into a market. And so you can see on the right what the emails look like, and they send this out once a month for all the markets that I've selected. I get it to my inbox, and so it talks about rent growth, occupancy, vacancy, leasing starts, all kinds of stuff. And then you can take that and plug it into underwriting. So what I'm going to show you guys is an eyesore. I'm actually going to just um, because you might consider this proprietary. So I'm going to pop.
I'm an LP in I'm an LP in maybe I think 26 offerings at this point. And so some of the
Mhm.
things that I like to you kind of get a beat on is okay, you're showing me kind of the baseline or maybe even the best case, right? And in this
Mhm.
case, we don't want to show the best case, right? So you're trying to show a worst, best, and a base, right?
Okay.
So you're trying to show them a range because we know that things might pop up, like Sarah, you just mentioned, right? The last 2 years was not like how the last 10 years were. So,
Hmm.
we want to show kind of the good, the bad, and the ugly, and let people
Yep.
know that, like, hey, even if it goes all the way down to 14.1, that you're still in a good spot from a return perspective, right? And
Mhm.
then, on the flip side, right? Maybe we hit a home run, right? We hit it out of the ballpark, and then there's that kind of the discrepancy between the mid, the best, and the worst. And so we like to show this because I think that this shows people that we're thinking through it, and I'm not just trying to present the best case scenario because we all know that it's going to be something else, right? And I think that's important for an investor, and me included, when I invest, to see those different
Hmm.
ranges.
Hmm. So since you have 1,200 units you're managing right now in Austin, what is the economic vacancy you're seeing right now in your portfolio?
It's currently about 91, 92. So it's even better than this. But again, I want to be conservative,
Hmm.
and that's occupancy versus vacancy. So what does that equate to for people? It'd be probably that 8 or 9. So it's on the top part of this table,
Hmm.
right? And so I don't want people to base their investment opinion on the best case.
Hmm.
That is what it's been over the last 3 or 4 years.
In your portfolio, is it kind of on par with what's going on in the market as
Yeah.
far as
Yeah. I mean, I've
occupancy?
got a property right up the road from here. It's at 92% occupied. Right. And then so, I mean, from that perspective, it's right in range with where this is at.
Awesome, thanks. Okay, so the next statistic we are going to look at is oh, excuse me, wrong way, the rent growth. So
Yep.
the link that Kath put in the chat that I was showing the website, you can look at rent growth. If you're like, how do I find this? It's really simple. That link, you just put in San Antonio, whatever market, and it'll show you a graph of what rent growth is looking like. And so in this example, showing that a range 2% rent growth, if you take a look at that on what was it, a $1,200 rent, 2% is such a small number. Um, and 5% is also, it's still a fairly small number, but it's all relative. So why for San Antonio did you choose 3.5% as the baseline?
Over the next 5 years, based on our data and research, kind of that's what the average was going to be. And it's a little, it kind of, it goes up and then it kind of steadies out, right? Because right now there's not a lot of rent growth that was called over the next 12 months in
Mm-hmm.
any market, right? It doesn't matter if it's San Antonio. Anybody that's telling you that's more than maybe 2 or 3% in any market outside of maybe some very isolated instances, maybe in the
Mm-hmm.
Northeast or some other markets, that's
Mm-hmm.
what it is. And so, it kind of ramps up to that and comes out as an average of 3.5. The other thing that I was going to mention about this slide too, because it's an important distinction, right? There's organic market rent growth, and
Mm-hmm.
then there's forced rent
Mm-hmm.
growth, right? And
Mm-hmm.
what do I mean by that? There's a distinction between the two. Organic is like, think of a comp, right? In a single family home. The comps are getting higher and higher. Things are selling for more and more, right? Same thing can happen with rents, right? All ships rise with the tide, right? Your competitors over here charging another $100. You start charging more $100. Now he's at 150. You're now at 150. Those things are called organic rent growth, right? That's just your it's just going up and up and up, right? That's the
Mm-hmm.
organic side of it.
Mm-hmm.
Now, there's a forced side of this. And what do I mean? It doesn't mean bad, it actually means great. What I love about commercial real estate is that there's a forced appreciation component of this. And what do I mean? It means I can put money into certain parts of the property to improve upon them. And because of that, I can charge more in rent. Your best ROI when it comes to a multifamily property to do that is your rent your units, right? Because at the end of the day, the residents don't care that your roof's replaced or that the ACs work or that the pool looks pretty. They just expect those things.
Yes.
But now, if you put your money into their home that they're going to be living in and you upgrade what's in their home and how they're going to live and they're, between the fit and finish and the technology that's in it, they will then pay you more for
Mm-hmm.
that same unit that maybe the last guy wasn't able to get because he wasn't putting the money in. That's the force side of this. And so there's a distinction here, and this is just the organic market rent growth component, right? There's also a value add component where, again, you force that rent up through putting money into the property and improving upon it.
Hmm. And this is representing though, when you say stabilized annual rent growth, you mean
Yep.
that the property's been remodeled, renovated, CapEx is done, and
Yep.
so that forced piece is over, and this is the natural
Yep.
piece.
Yep.
Yeah, perfect. All right, the last item we want to look at when doing a sensitivity analysis, in what we're talking about today at least, is cap rate. And so, does the ALN data, does it have cap rate? I can't remember now. But cap rates you can research, and there's,
Those are a little bit harder
yeah.
to get a good beat on. I always call brokers and where are things trading at. Those are probably the best, indicators. I mean, CoStar might have a little bit of data, ALN might have a little bit of data.
Mhm.
Another one for people to know is ADS also has similar type rent comp data information as well. But, in a lot of ways, the brokers that are selling these deals, those guys and gals, they really have the best beat on cap rates and where things are trading at. So the one thing I mentioned about this table, right? So currently, this type of product should be trading between 4.75 and five and a quarter. Buying it above a six. And the reason why is that the operations are suboptimal. They're not right. They're not running a stabilized property. There's
Mhm.
expenses that are missing. There's revenue growth that's not being achieved. Occupancy that could be optimized. There's a lot of things that water down the financial performance of this asset, and so therefore, that plus the basis that I'm getting at, I'm actually getting it at a pretty good going in cap rate. But if it
Mhm.
was a stabilized property, it should be between 4.75 and five and a quarter. So that's what that means. And so we went on the high side of it and picked the five and a quarter as the exit cap that we were going to underwrite to, and that's where you achieve these returns.
And brokers in the San Antonio area, are they making projections that cap rates will go up, down, stay stable over the next 3, 4
They
years?
think that everybody seems to think that they're going to compress, right? And when I mean compress, that means that they're going to go down, right?
Mhm.
Because we all believe that interest rates are going to go down, right? And they're not, it's not a one for one correlation. So I want to just preface that,
Yep.
but there is some trends that, hey, if interest rates go down, the cost of capital is going to get cheaper. So then there's going to be more of a buying frenzy. People are going to be more apt to jump back in the market and buy. And when that happens, there's a lot more demand versus supply, and it drives cap rates down and drives values up. Right. So again, I think we're being conservative on a five and a quarter cap based on the fact that it's a 2007 build.
And if you're in the audience and you think, oh, I don't think interest rates are going to come down, I've been doing real estate for 50 years, and this is really low in the history of real estate. I don't think it's going to go any lower. We're at a good spot. Then taking a look at that mid-range that's on the screen right now is kind of where it would be, where it is today then, right?
Yep.
No. Okay, well, that was our last planned content slide. And so I think we have about 10 minutes left. Ben, are you good if we go a little bit over, if we
Good.
just jump into
Good.
Q&A now? Okay,
Absolutely.
let's see. All right. So it would be easiest for us if you guys would put all your questions in the Q&A, because then once we answer them, we can click, okay, we answered it, we can go on to the next one. So I'll scan the chat window as well, but if you can put all your questions in the Q&A feature, so at the bottom of the screen, in the middle of your screen, it should have a little icon that says Q&A, and you can type your question in there. So before we dive into questions, I see two that are there already. If you want to take a look at them, Ben. I want to say, everyone, this has been recorded. It will be sent out today, and again, you can share it with whoever you'd like to share it with. We will be having a webinar. I believe it'll be next Thursday, same time, same place, if that works for you, Ben. So that will be July 3rd, and we'll be specifically talking about an investment opportunity in the San Antonio market that we're doing together. So we will also send out an invitation later today to register for that. And then tomorrow it'll be up on the platform
Mhm.
at sugocapital.com/build, and you can check it out in the portfolio and the details, and then sign up to join us again next week to talk about a specific investment opportunity. If you're not ready to invest and you're just here to learn, feel free to just review the information. We also have a checklist on our website. It's a market due diligence checklist. So it takes what we said today and it just turns it into a checklist. Like, look at this data, look at this data, look at this data. So when we send out the replay, we'll send a link to that market due diligence checklist as well. So, all right, I'm going to jump over to the Q&A and I'll start with Mary's question. So Mary's asking, if we're investing from a 1031 exchange, how is the cash handled after the sale of the investment? So, so Mary, if you're talking about the sale of the, like, say you go into a syndication with Sugo Capital and Disrupt Equity, when we sell the property, you can 1031 exchange out of it. So I think that's the nature of your question. You can, if you 1031 exchange into one of our offerings, you can 1031 exchange out of it when we sell it as well. If
Yeah,
you're
and I mean,
talking,
you're just, I think the 1031 is just they're a partner with the partnership,
yes.
right? So they're an owner of the real property on there.
Mhm.
And I think that's an important thing to understand. 1031s, there's a lot of nuances to it. There's a lot of good firms that can kind of answer all those questions, but both us and Sugo, we obviously accept 1031 exchanges into all these offerings.
Yep. And if you guys have a 1031 exchange that you are in the middle of or about to do, we can also do reverse 1031 exchanges. Ben and I already chatted about this because we have two folks who want to do a reverse 1031 exchange into the next opportunity. That's possible as well. So just send an email to hello@sugocapital.com. And if you want to do a 1031 exchange into one of our properties, and we'll get you the details. Now, if you're specifically talking about the cash, don't take the cash. If you take the cash after your sale, you can't 1031
Yeah,
exchange. Those are
you'll
the
have a
IRS.
you have a tax consequence.
Yeah, that's not our rules. That's the IRS rules. If you take possession of the cash, it's over. All right. This next one from Vishal might be for you, Ben.
Yeah, I can handle this one. And I think, I mean, I'm happy to always answer all these questions, right? So
Yeah.
Texas three pack and Woodway, San Antonio deal are two assets that have paused distributions after 1.5 years. Rents have seemed to stall and far off from, I'm assuming projections. What caused the missing projections and why should we trust your projections now? And Visual, I appreciate the candidness. I think there's, I mean, we've been very candid about some of the challenges that we had to take over from the three pack, which is not even in San Antonio, but Hill at Woodway obviously needed a lot more work. Took a little bit longer for us to reposition that property, but it's currently 92% occupied. The work's been done, and rents are starting to kind of go back the other way. But you don't really want to increase a lot of rents whenever you're kind of going through a heavy value add in capex play, which is what we were doing on all those assets. In fact, you're trying to not buy occupancy, but you're trying to make sure that your occupancy doesn't fall further. But even the Texas three pack is currently at 92% across the whole portfolio. And so, and as we kind of continue to accrue the preferred return and have enough, cash reserves on hand to make it a healthy investment, then we start those distributions up in at the end of the day. So I think it's ultimately we are looking out for what's in the best interest of not only the property and the partnership, but also we have to balance that with distributions too. And it's a long-term thing. I think the one thing about real estate is it's not a 1 or 2 year play, right? All of those deals are 5 to 7 year plays. And over the lifespan of those, they're going to be very, very successful. I believe in those assets. In fact, I was just out at Woodway last week. And so I believe in those assets and I'm excited to kind of see how they start performing now that we've kind of gotten through a lot of the capital and gotten the occupancy to where I expect it to be.
Thanks for that. Um, all right. Next one is from Jen. Can you provide more insight on how you manage taxes and insurance in Texas, as this seems to be a big pain point for any investment over the last couple of years?
Yeah, tell me about it. So I think yes, that is a great. I'm glad that we brought this up because I think taxes and insurance always a hot button issue in a lot of markets, not just Texas. So let me and I have the benefit that we own an insurance agency and
Oh, well, there you go.
we manage about 200 properties and on
Mm,
the insurance side, it's about 4.5 billion in TIV that we have within the insurance agency itself. And so I have a very good beat on insurance in Texas specifically. And I think things are starting to go down, right? We saw a 20 to 50% increase from 2022 to 2023 and then again from 23 to 24. So it was very painful, right? And in some of those properties you can imagine a 20 to 50% increase on some of these property sizes is a massive dollar amount. Well, what we saw on this last renewal and what we're going to see on this next renewal, which is going in from 25 to 26, is a decrease from 10 to 30%. And people are like, why is it fluctuating so much? Well, I'm going to tell you why. First of all, everybody knows about all the natural disasters that have happened across the country, right? And the big ones that really hit between 22, 23, and 23 and 24, where you had massive hurricanes in Florida, and the insurance carriers took about a $20 billion loss in Florida alone. So this is not considering the fires that might have happened in LA, all of these things. Those things are somewhat insulated, but what they do when you have something along the coast is they kind of get everybody that's along the coast gets a price increase. And so I think at the end of the day, they got their pound of flesh. We saw the reduction of 10 to 30% from 24 to 25. And our carriers are telling us you're going to see an additional 10 to 30% reduction, which we did not underwrite to. We kept ours, we increased ours because we know we want to be trying to be conservative. I'm never going to try to say it's going to be a 10 or 30% decrease, but that's what it's going to be. And so, yes, could it be challenged in the future? Absolutely. But we always increase our taxes and insurance more than our regular expenses. And so I think we take that into consideration. Now, flipping to the tax side, we always work with a property tax protest firm, right? It's not just us. It would be naive of me to say I'm never going to protest taxes or I'm going to do it on my own. You always work through a third party here in Texas. It's a non-disclosure state, and you always get an estimate of what your taxes are going to be before you even buy the property. So this has not been thinking like, how much should I put taxes and insurance in our underwriting? I'm working with these third party sources to validate this data. And again,
Mhm.
we feel very, very confident in our value is either on the conservative side or it could even be a little bit less. But again, we kept that conservative number in terms of taxes. And then you just have to fight it out. Overall, over the last 3 to 4 years, because we kind of did a post-mortem on a lot of our deals, the one thing that had come down on all the expenses, because we all know about inflation too, was the taxes. So
Mm,
taxes hasn't clipped away as much or as aggressively as some of the other stuff has.
okay.
But again, trying to be conservative, we went through the third party. They did their valuation. They determined Bear County is going to evaluate at this, and then we went and we took that high number. And so I feel pretty good about where we're at on this side of things.
Have you done tax abatement on any of your properties?
We have, there's various tax abatement programs. There's local, there's traveling, there's PFC, there's HFC, there's all of these things, but we're not doing that on this deal. Because it's kind of more, well, I'm not going to say it's necessarily tied to affordable properties, but it was a strategy that was kind of implemented in a lot of ways the last 12 to 18 months on a lot of different deals, but we're not going to be doing that on this
Okay.
property.
All right. A couple of people asked, are there deals open for non-accredited investors at
We
Sugo
we
Cap?
we do. I mean, I won't speak for you, Sarah. Sorry, I didn't mean to jump in there, but we do occasionally do some of those, but not typically.
Okay. And we do not. We have in the past. We may in the future, but we don't have any right now. All right. Hi, Michelle. Thanks for your questions. Do your preferred returns pay, or if they don't pay monthly, do they accrue versus non-preferred returns? Do you have occupancy requirements in order to pay monthly or quarterly cash flow?
Preferred
So
return.
that's a good question. So Ben, if you have I'm going to try to rephrase it. So if you have a preferred return, does that equal cash flow projections, or or are those different things in most of the time in your properties? Like if you say it's an 8% preferred return, should someone expect an 8% cash flow? And if it doesn't happen, is there a catch up?
There is a catch up. Everything always accrues, right? So
Mhm.
I want to preface that. Yes, so there is an A prefer. Typically on our deals, anywhere from 7 to 9. Just depends on the type of deal,
Mhm.
and that is you get that even the accrued amount before we take a penny on our side. So I always like to preface that, right? So but the preferred return is different than the cash flow. So I want to make a distinction here, right? So
Mhm.
say for example you have an 8% preferred return, but your average cash on cash is 7. You should expect that 1% is going to be accrued on the back end and paid upon either a refinance or a sale.
Perfect. I'm going to jump down to Sam's. Because I like this question. Thank you, Sam. What are the possible risks, especially in the current economic cycle? And you can say, you can answer, Ben, if you want to answer what you think the risks are to multifamily or specifically to San Antonio.
So, what is the possible risk, especially in the current economic cycle? I think a lot of the uncertainty that we had in 22, in terms of inflation, in terms of interest rates, I think a lot of that is now been, we know what we're up. We know what the new normal looks like, in
Hmm.
terms of what rates are going to be. I think inflation is starting to taper off. I think the one big thing is the black swan, right? And I hate to say it, another COVID event, a world war, something like that, which will rock the overall economy could be bad. I think the only other thing and I don't like to get into politics on any of this stuff, but we don't know where the tariffs are going to go. I don't think anybody, I mean, I think we've cut a couple deals. Um, but I don't think that all of that is done yet. And so we have to understand that that could potentially increase the cost of certain things, right? And so that's probably the biggest wild card that I mean, because God forbid nothing happens on a COVID type situation or a World War III situation. I think
Right.
the most near term economic risk that people have is probably tariffs.
Okay, thanks for that. I see some questions about what's the average hold time and returns. And so when you look at a specific opportunity, we'll give you that information for the specific deal. But basically, at Sugo Capital, we look at something that has a hold period of 3 to 6 years. Usually, our folks don't like to have a 10-year hold or longer. And we look for something that's between at least 18% annualized return, often 18 to 22% is what we see in projections. See a lot of questions about how can we invest? Can I invest from a solo 401k? Can I invest from an IRA? And the answer is yes. Everything at Sugo Capital in the Sugo Capital Fund, you can invest via an LLC, a partnership, in your individual name, via your trust, your retirement accounts. So pretty much anything goes. There's not a way that I can think of that you can't, as long as it's, you're in a self-directed retirement account. So that answers a batch of questions there. I see some folks asking about what does it mean to be an accredited investor. So, Kath, if you could put in the chat the link to Parallel Markets, and it's a free service to get an accredited investor letter, or you can get one signed by your CPA if they provide that for you. But you can qualify two ways, either by income. So if you make an income of 200,000 or more per year, or 300,000 or more per year as a couple. So that's via income. Or you can qualify by net worth if you have a net worth of $1 million or more, not including your home residence that you live in. All right, back to market type questions. Mary's asking, is New Braunfels part of the San Antonio market? I'll let you take that
So I
one.
talked about kind of that 35 corridor. It's right in the smack middle of that, and it's close to San Marcos. So I would probably say no, it's its own market, but it's very close. I mean, it's within 20 or 30 minutes of San Antonio.
Awesome. Maggie's saying she'd like to know about disrupt equity deals in Atlanta. Kath, can you make a note for me to email Maggie the information? But you guys will see it come out um, in a few weeks, but we can give you a sneak peek early, Maggie. Let's see. All right, this is one for you, Ben. The past 2 to 3 years have been tough for real estate investors. Have you ever lost investor money?
No, we have not. Are there
Congratulations.
is there properties like Vishal had mentioned that I'd love for them to be a little bit further along? Absolutely. But I
Mhm.
always kind of talk to people about like the three I's, right? Insurance, inflation, interest rates have just really been a very big challenge that we've had to get through over the last 2 or 3 years. And some of those really took a lot of people down. I think we've been able to manage that, a lot more effectively just through our relationships and kind of the capital that we brought to the table. But it's been tough, and I think the one thing I wanted to mention, this is not a sales pitch. This is just I mean, and I'm an LP just like everybody that's on this call, right? You need to be investing when there's blood in the water, when there is that trough, when you see the fact that things are going to start eventually going back up. This is the time to be investing in real estate. We all got that FOMO. I did. Out of those 26 investments, I think 20 of them were done in 21 and 22. So you can imagine I'm hurting a little bit on some of my stuff too. But at the end of the day, we were investing when we shouldn't have been, and then we don't invest when we should, right? And I think it's all about market cycles, right? And so you kind of see this trough right now where interest rates are kind of we get them, and then yes, we can quibble about like are they going to go down further? At the end of the day, I don't think they're going up. So we at least know that this is the baseline. You're getting fixed rate debt, which is good. It's not a variable rate. Insurance market has calmed down. We got that. Inflation data has gone down, and that's more stable. So those three I's that were really a big challenge the last 2 or 3 years, we now kind of know what that looks like, and we're able to mitigate all of those big factors, right? And I think that that makes it de-risked in terms of going into this next part of the market cycle.
Okay, awesome. Thank you for that. I see another question in the chat, and I don't know if you know this offhand, Ben, and kudos to you if you do know. The break, do you know what occupancy you need on the new deal in San Antonio? What occupancy you need in order to distribute the cash flow that you have in the projections? And
What
I don't have
occupancy?
the
I mean, again, it goes
underwriting
back to that. I think that's the 11.1, right? That's the baseline that we underwrote to.
for
Is
the
kind of
cash on
what,
cash.
yeah,
Well, and the okay, yeah, there you go.
yeah. So that's the all in, right? Between physical and economic, that's what it is.
Okay, perfect. So Michelle, I hope that answers the second part of the question I didn't see earlier. Okay. Yes. Yes, Michelle. Um, okay. One more question. Um, okay, property. So in your I'm going to rephrase this question. So insurance, um, when you put insurance costs into your underwriting, do you do a sensitivity analysis on that as well and show, okay, well, this is the range we think it'll be in, or do you put in one number in your underwriting for property?
No, we trend it differently, right? So that's kind of what I was alluding to before.
Yeah.
We trend three different things on the expense side. Regular kind of operational expenses are trended at anywhere from 2 to 3. Taxes is trended differently. Insurance is trended differently. Nobody's going to trend at 20% a clip a year. No deal in the whole entire United States. Nobody ever underwrites that aggressively. But we also, again, have a beat on what it is. So I think we trend typically taxes, insurance anywhere from 5 to 10% a year. The other operational expenses are usually 2 to 3%.
Cool, thank you.
Yep.
Um, all right, Peter, you would say private deal. Now Jen has a great question, and I think this is a great final question. Can you talk about how the U.S. growing debt could potentially cause a problem for real estate investment and whether you have a contingency plan for this? That's a big question, Jen.
That's huge. I mean, I mean, we might want to get that one over to Jerome Powell. I think, at the end of the day, I think in a lot of ways, again, not getting political, that's one of the reasons why this administration is putting a lot of pressure on the Fed to drop rates so they can refinance their debt at a
Mhm.
lower interest rate and save a ton on the debt itself. I think we do have a spending problem. Again, don't want to get political. I think
Mhm.
both sides of the aisle need to do a little bit better, have a little bit more fiscal responsibility. I still think that obviously, the United States economy, don't bet against it. Warren Buffett says that, it's going to continue to clip away. I think the projections are pretty solid, but, I think that's something that any administration, both sides of the aisle needs to figure out our spending problem.
Mhm. I agree. All right, well, with that, we will wrap it up. Everyone, the recording will be sent out in a couple hours. And again, feel free to share it. And we'll have links to resources in that email as well. And then we'll have Ben back to talk about specific opportunities in the San Antonio area. And then after that, we'll talk about Atlanta and opportunities in the Atlanta market. So even if you're not ready to invest now, but you're looking to make some real estate investments later this year, I encourage you to come to all of the webinars where we have been and the Disrupt Equity team, because that's part of your due diligence and your research is getting familiar. You heard how Ben thinks about underwriting, how he thinks about markets, how he thinks about real estate, debt, etc. So the more you hear, the better equipped you're going to be to make a decision later when you do have the money to invest. Even if you're looking to place money in November, I encourage you to come and listen and get familiar with Ben, and then you make a decision Whether you want to invest with disrupt equity before you have to place your money, it's the best way to do it. So Ben, I want to say thanks for sharing your knowledge, your the way you do research, the way you do your market analysis, the way you look at properties and real estate, and being very transparent through this whole process. It's very appreciated, and everyone, I have a lot of faith in the Disrupt Equity team because of the transparency that they have had with us during our due diligence process with them. So Ben, I want to say I appreciate that, and any final words you want to share with the audience?
No, I just, thank you, Sarah, for letting me come on. And again, I love talking shop. And
Yeah.
um, the one thing that I'd mention about, investing, because again, I'm an LP too, is you got to like, know, and trust the people that you're investing with, and transparency. It starts with that, right? Just being candid and understanding that, things do go awry sometimes and you're backing the jockey, not the horse.
Mm-hmm.
So thanks again for letting me come on, and hopefully everybody got some value out of today.
I think so. Did you guys get some value? I see a lot of thanks and thank yous. Thank you,
All
Ben and
right.
Sarah. You're very
Everybody.
welcome, everyone.
Thank
All
you.
right. Well, with that, have a great rest of your day, and we'll see you all next week. Thank you, Ben.
Thanks, everybody.
Bye bye.